You're listening to Across the Pond, a show about improving the lives of British expats living in America. Brought to you by First Wealth.
Hi there, Tom.
How are you doing?
I'm good. Okay, so this is our inaugural investment review podcast. Our first time tackling this.
Yeah.
Hopefully, we will get through it without being interrupted by a pregnant lady coming through your door, insisting that you leave and take her to hospital. So let's crack on. But this is, our first podcast on investment matters, which is probably a good time to start doing one.
It is. So I've been doing a version of our quarterly market, or a version of a quarterly market review for the last 7 years. And as I was writing this one, I thought, what are the themes? Or I could sense two themes that seem to filter through every one of these reviews. First one is we jump from crisis to crisis. I think that's palpable, isn't it, really?
We don't go from one crisis to this panacea of contentment and certainty. Oh, that's nice. Now, isn't just plain sailing ahead? That just doesn't happen, does it?
It doesn't. And this last quarter just feels a testament to that. But the other theme is that we get through it in the end. And we could just drop the mic there, couldn't we, really?
Faith in the future.
Yes.
Nick Murray would say, faith in the future.
And this quarter, I had a strange feeling I get every 2 years. Something happens, and I have a strange feeling, just visceral feeling. I got it in COVID. I got it again this quarter, and we'll speak about it. We'll speak about it shortly.
Just to go back to your first point about crisis to crisis.
Mm-hmm.
And I said we don't go from crisis to a period of certainty. Looking back, those humans with our many weaknesses and foibles, we tend to look back and blur out the bad stuff and think of that. Oh, that was a good time.
Rose tinted glasses. Yeah.
But when you're in it, I guarantee you there is a crisis du jour. Even if there's not really, someone's manufacturing to sell newspapers or whatever it is, ads these days. There is a crisis du jour, probably several, and that's the kind of loop we're in. And actually, it's got worse because of social media. Now we're going off topic. Now we're having a social commentary. But the point is, looking back is one thing, but in the moment, if you think about it, we don't go from crisis to certainty. We go from crisis to crisis. I fully agree with that, and I totally agree with have faith in the future. We will overcome this. This too shall pass mentality.
Yeah, you always hear, how good was it back in my day? It's like, well, actually, no, it wasn't, because you were on rations and you couldn't afford to go go on holiday abroad. You had to holiday in the UK and all those types of things. But
it's like people who think. Yeah, it's like people who think house prices just go steadily up, because there's not an app on your phone where you check it every day, so you kind of insulate it. It doesn't mean they're not fluctuating wildly. It just means you view it differently. Therefore, you have different feelings towards it. Might not be accurate, but they are real. Yeah.
So let's start with the quarter by. I always start with the quarter by numbers, as I would call it, and we'll look at two main sectors. Here we'll look at equities and bonds, and we're going to look at the All Country World Index, so the MSCI All.
So this is Q3, right? Q3 2022, July, August, September.
Yes.
Not a pretty quarter.
No, not across. There's sort of nowhere to hide, is what I've been saying to clients in the last few months. Really, you could put all your money in commodities if you wanted to make some money, and in hindsight, you could have made some money this year in commodities. But then, do you want to commit more of your pension money or your money that you're going to use for later in life to a sector that's renowned for huge booms and busts and companies firing and hiring? Which the answer is no. So the way to achieve long-term returns is investing in a portfolio of global equities and bonds. And global equities this quarter are down 7.74%, which now sits the year at 26% down.
26% down. Global equities. So that's a big fall.
That is. We don't get 25% drops very often, do we?
I think I read 9 times since 1950. So, just over once every decade. So, what do we normally say? We normally say, I'm actually looking at a chart here which shows generally 3 years out of 4 markets go up. 1 year out of 4 they fall. We just don't know which year that is. So, but a 25% fall. Well, that's I mean, we're not through the year yet, but that's even less common. That's once every 8-9 years.
Everything's on sale by 25%.
Everything's on sale. That's the thing. That's the thing to bear in mind. This is not much comfort for people who are already invested. Although the comfort is we've recovered from every bear market / recession ever, and we have faith in the future. We don't think this will be any different. We'll go on to new highs. But for people who have got money on the sidelines, then stocks are on sale. The future returns have gone up dramatically, or future expected returns have gone up dramatically because the price has been cut by 25%.
Yeah, it's true. And a similar story happens across bonds as well. So bonds also down 7% for the quarter, now sitting at negative 20% year to date. And when I say bonds, I mean the Bloomberg Barclays Global Aggregate USD. So that's global corporate government bonds.
Right? Like, we can all handle equities falling. It's part of the course. It's part of the contract. Unofficial contract of risking volatile assets. You got to have these things, but a 20% fall in bonds is at the same time is just hideous, frankly. Bonds are, I would argue, an attractive proposition, a very attractive proposition again, but again, that's not much comfort for people who've had to sit through that.
So the UK. Let's start with that one as one of our main topics. We're going to go through 3 topics. We're going to start with the UK. What the hell happened in the UK this quarter? And then we'll move on to inflation, recession concerns, and then we'll probably finish off with some of the global, what's going on in China, Europe at the moment as well. So the UK, did everyone see the mini budget? What's been reversed since you hear this? But I guess one of the main things from the mini budget was what happened to sterling. And
so, are we talking about the UK, or are we talking about currency, or both?
Bit of both, I guess. I mean, so the UK, I think people forget when they move to the US, they move to a much bigger economy. They probably decide to stay in the US, and they think, the UK is just that small island. That small island no longer in Europe, and they forget the significance still of the UK market, because it is significant. It's the 6th largest contributor to global GDP. It's got one of the strongest currencies in the world. It's also the home of a lot of multinationals. Some of the biggest corporations in the world have their HQ in the UK and are on the UK stock exchange. It's still a huge part of the global economy, although it might be shrinking.
I hope we're still saying that in 10 years. I'm less confident than I was, but I hope we are still saying that in 10 years. But yeah, the UK had a massive wobble, own goal. I think own goal. Even if you agree with what they did, which I don't think I do. In fact, I don't. But even if you do, I think the way it was done was a bit of an own goal. And that was, and we saw that with the way the pound got priced. I mean, everyone who's listening to this, we can remember $2 to the pound, to be down at 1.04, 1.03. I feel for people who have got a high level of fixed income, and by that I mean retirement income, final salary pensions.
Okay, yeah.
Who are receiving an income in pounds, because over the last 10, 15 years, they're practically halved. I mean, it's practically halved, which is just horrible.
I speak to people,
but I think that
have received a defined benefit final salary pension 10 years ago, and 2-to-1 they receive their UK state pension. And yes, it's gone up incrementally by UK inflation, 2.5% a year, but the currency swings have been much more volatile, and as a result has cut their pensions in half. It impacts.
I think though what we saw in the currency was that blow up, which was the day was saved by the Bank of England, basically. But that was Britain, that was the UK messing up, in my opinion, and the market reacted, and the currency market reacted. That the longer term weakness of the pound and the euro, but the longer term against the dollar is part UK, part things like Brexit. Again, whatever you think about it, it led to the currency being devalued. There is definitely elements of this weaker pound that fall squarely at the doorstep of the UK. But I think the issue we are confronted with right now is much more of a story of a strong dollar.
I mean, look at it across all global currencies: the yen, euro, Aussie dollar. It's the same pattern. The dollar is so strong, which is not good.
So strong.
It's not good, is it, for the global economy?
It's not good for anyone. Arguably, maybe it's good for the US in the short term because it keeps down the cost of imports, which is putting a lid on inflation, right? Mm-hmm. But at the same time as screwing over the rest of the world, who owe a lot of money in dollars, so they get squeezed, and US companies, the biggest US companies, earn a lot of their money from overseas. They repatriate that to the US, and it's worth a lot less in US dollars, and that hurts the US. We have an earnings recession, corporate profit setbacks, and no one wins. No one. Maybe the short term for inflation quelling in the US, maybe, but I think what's happening right now is an egregiously strong US dollar, and I don't really think it's in anyone's best interests. And I hope something will have to be done about it. I listened to something this morning which made a parallel between this and the late 70s, early 80s, when the dollar was extremely strong. And apparently this is the genesis of the G7 or G8, whichever it is now, G7 I think. And apparently the G5, as it was then, or it wasn't actually, it became the G5, got together in the Plaza in New York and agreed to sign these Plaza Accords. I'm regurgitating what I've heard from someone today, so if I'm getting this wrong, I apologise. But basically, they agreed that these are the big countries would have to sell their US foreign reserves, and that's what weakened the dollar. Now,
are we there?
I think the current biggest holders. Well, I think the biggest holders now are Japan and China, not France, Britain. So I don't know.
Right. So,
but something this commentator was basically saying this isn't going to just happen. Something has to happen, but something has to be the issue has to be forced. But they think it will be because this is not in anyone's best interests. And I'd certainly like to see the dollar weaken up a little bit.
Yeah, wouldn't we all? Managing money in the UK, impacting our revenues as a business, and impacting so many Brits across America that are solely reliant on their pensions, as you say, as their income from the UK state for retirement. It's we hope it's a temporary position. Whether we'll go back up to the glory days of 1.5. Pre-Brexit, which is the historical mean still, who knows? But
you can only hope.
Yeah, once we get out of this uncertainty, because that's a strong, that's a strengthening position for the dollar. When there's uncertainty in the market, people go to safe havens, people go to the dollar. So once we're through that, and then maybe the Fed looks to lower interest rates, which I think they said they're looking for a short, sharp interest rate increase now to stem inflation, and then they'll look to bring interest rates back down to spur economic growth again. So when that happens, that is a weakening sign for the dollar. And as a result, that should just naturally strengthen the pound. And now what happens in the UK in the next 6, 12, 18 months? Who knows? I mean, no one was expecting what happened in the mini budget, and that was the main reason why sterling fell so quickly, wasn't it? Because of the shock, because no one was expecting that, and that is what the market hates.
And they didn't believe in it.
Yeah, and they still don't believe in it.
Yeah,
most people don't.
Yeah, no, but specifically these unfunded tax cuts, that was the market voting,
and they listened.
Yeah,
because they have repealed the 45% income tax cut. Okay, so the UK. We've got obviously new Prime Minister moving forward. Who knows what's yet to come for sterling? But yeah, it's been a busy month in the UK with the Queen and Boris gone. So next, US. Main talked about topics this quarter were in obviously inflation, continuing inflation problems, and recession concerns. We could already be in a recession, more than likely, and
so it's going to come down to jobs, which will. So Q3 was rough, and we're having this conversation now. In a couple of days, jobs data will come out because they need jobs to go down before we have a recession. But then there's a whole thing. We can talk about recession very glibly. Like, it's serious business. I read someone was saying, like, we shouldn't be so blasé about this. Yes, we need to quell inflation, but it's much easier for people to recover from a bear market than it is from a job loss. It's like, oh yeah, that rings true. I hadn't thought about it in such. I hadn't thought about it in those terms before. I just thought, yes, if recession is what it takes, then let's do it. And I think that is what it's going to take. But we shouldn't be so glib about it. But yeah, we've got jobs, and then this week, then next week. When this comes out, I think maybe the day this comes out, there'll be the inflation update. That wasn't what people were hoping for in September. That spurred a new round of sell-offs, basically. And then we've got earnings reports, and there's a lot of talk about an earnings recession for these companies, which didn't happen in July. Basically, companies saying they're not making as much profit. And then there's the fact that most market bottoms have happened in October. 9. But a lot happened in September. So it's going to be if all this data stacks up in one way or another, we're either going to plunge to new lows, or was 2 days ago the bottom. But a lot's going to happen in October. I know we're looking backwards at what happened last quarter, but a lot is riding on right now. Yeah,
and there's still a lot of good in the market, in the economy, isn't there, at the moment? And as you say, you've said jobs there a few times. That's key, because if people are still employed, people have money coming in, money to spend, and yes, inflation is at 8-9%, but wage increases have been between 4 or 5%. So actually, real inflation for these employed people is 3 or 4%, which yes isn't great, and yes isn't sustainable, and yes the Fed are trying to bring that down by raising interest rates, but people still have money in their pockets to go out and spend and keep this economy going.
That's part of the problem, is people have money in their pockets to spend, because we've had this massive overstimulus. I mean, that's a good thing and a bad thing. So this is not 2008, right? 2008, households were over-leveraged to the max, mortgage up to their eyeballs, and the whole house of cards came tumbling down, right? Banks were all over-leveraged, linked, and people just personal and professional bankruptcies everywhere. It was just horrible. This is totally different. The consumer balance sheet was in a much better place pre-COVID, and then they just threw too much money at. They just overstimulated the economy during COVID. I applaud what they were trying to do, but they went way too far, and this is the result essentially. But this is not 2008. The problem is people do have money to spend, and lifestyle is a stubborn thing. Once people get used to that, extra meal out or whatever it might be, extra holiday, that is a hard thing to give up, and that's really, I think, what they are trying to quell now, and they will. It's just about whether they put it into recession or not. But it's not 2008. The banks aren't. The consumer is not in the state they were in 2008, and the banks aren't in the way they were in 2008. They're well capitalized. They're not as linked. And we have Credit Suisse teetering right now. And people are saying it's like Lehman's, and it's not. I mean, it would be massive, catastrophic, terrifying, but it's not going to bring down the whole banking system, which Lehman could have done. So 25% down doesn't mean there's not more. Consumer sentiment is way down, which is normally a sign that we're out on the bottom. Stocks are oversold. Doesn't mean they can't get worse or go on for longer, right? But these are all indicators that there's a lot of bad news priced in. And CEOs, I think you sent me something the other day, saying the CEOs 80% are planning for recessions and have been doing. Feels like a bit like a slow-moving car crash. Doesn't mean it won't get painful, but it's not going to be like everything screeches to a halt and the wheels fall off overnight and everyone's running around on fire. It wasn't like it felt in 2008.
Yeah, well,
it's not that.
A lot of recessions come from new information, like new news, new shocks. Like 2008, no one knew that it was so systemic. No one knew that there was phony mortgages being resold to other institutions. That, at least that we know at the moment, everything is known, and CEOs are making conscious decisions, expecting where interest rates are going to go as inflation is very high. But it appears that in the Fortune 500, companies, 80%, as you say, are either doing hiring freezes or laying off certain people in the company. Now, that just might be the low-hanging fruit. But people are preparing for some worse economic times to come, but not in a getting rid of 20% of staff. Everyone's get the wooden boxes at the front of the office because there's going to be mass firings. We're not there, are we?
Getting the house in order, no. And it doesn't mean that there won't be a massive earthquake in San Fran tomorrow, or something unexpected. I mean, there will be unexpected things. We just don't know that could have something that we're not even considering, which is why it's kind of impossible to. There's just too many moving parts. There's too many unknowns. Don't want to sound like Donald Rumsfeld here, but which is why we try and kind of like it's interesting to talk about this stuff. The parallels, the historical significance. It's all interesting, but it's important to rise above it and see the bigger picture. Which is we're fortunate enough that what we do is long-term investing, and you have the luxury of being able to step back from this. We're not traders. Look back and say, this is horrible. This is ugly. We didn't know it was going to be this. I didn't know it was going to be a war in Ukraine. I didn't know inflation. Some people knew inflation was going to take off. But a lot of these people were saying it for the decade of zero interest rates, right? So, they were banging a drum for 10 years in advance.
They were wrong for 10 years in advance.
Yeah. And we have the luxury kind of stepping back saying, this is ugly, this is nasty, this is horrible, we're not enjoying this, but this is going to be fine. Even if it gets worse, it's going to be fine. We'll come through this. If you have money to invest, get it invested now. We read something, didn't we? Ray Dalio was saying there's another 20% fall potentially going to come, and this commentator was saying, look, investors should not be worried about the S&P going from 3.9 to 3.1. They should be worried about the S&P going, with them in it, they should be worried about the S&P going from 3.1 to 6.2, basically doubling, and them not being in it. Right, yeah. And that is it.
Yeah, I completely agree. I think that's what I've been saying to clients in the last sort of 6 to 8 weeks. It's probably the smart money isn't allocating at the moment. What you said, it was 9 times that the market is 25% down since 1950, so a 25% sale doesn't come around very often. So if you've got money and you're contributing to your 401k, make sure those things are maxed out, allocate, and if you want to go on holiday, go to the UK, because
Europe,
because your dollars go so far. Go take your family out for dinner and
some Italian wine.
All that, Sangiovese, that's one of your favourites, isn't it? So elsewhere, so we speak about the UK, US, elsewhere, a lot going on in the world at the moment. China continue to try and be COVID free. So shutting down factories and trying to quell COVID outbreaks, with further lockdowns. What that means for us in the developed world is supply chain problems, inflation problems, because less things are getting made, less things being available means the price goes up. So that's an impact. That's an inflationary impact. Is that policy? China have their own problems, I think, at the moment as well, don't they? They don't have this inflation problem like the US, UK, Europe have. They actually have reasonably low inflation. They're actually lowering interest rates to try and stimulate some economic growth. But they
have a bit of a they've got this zero COVID policy, which is shut down the economy. They've got this property crisis looming. They're having a property crisis right now, a big property liquidity crunch, and also the kind of crackdown on the tech funds, to tech titans over the last few years has, I think, stifled the economy a little bit. So that China feels a little bit like an own goal as well, like a self-inflicted wound. But I don't think we should try and peer into their minds. And President Xi, he's got his own objectives, which is total and complete power. The last couple of years, China has not been what we would have hoped from it.
Slowing growth. And talking of global powers looking for world domination, of course we've got problems in Russia, in Ukraine and Europe. As a result, we've got extremely high inflation in Europe, including the UK. It's higher in the UK and Europe because of a strong dollar as well, because loads of things around the world are priced in dollars. The dollar is the global reserve currency, and when your currency weakens against the dollar, that just pushes prices up. And if you think about oil, that's the most common one. If that's priced at $100, that would have cost you £70 to buy a barrel of oil, and now it would cost you near 90. So that's an inflationary pressure on the UK, and the same's happening in Europe. So there's a lot of concern in Europe, isn't there? Probably more so than the US and the UK. But they're looking to raise interest rates now, and try and quell some of this inflation, which is something they haven't done for 12 years, since 2008.
Yeah. And it's got to be done. We've got to quell inflation, and they will. They are extremely committed to it, even if it puts us into a recession. And I would love to avoid a recession, but that might be the price we have to pay, or do pay, to quell it. Anecdotally, I see prices coming down. Gas prices are coming down. Shopping's not necessarily, but
I think inflation is probably here to stay for a while, isn't it? So, okay. Yeah. Anything else that you've seen over the quarter that's...
No, just so what I keep tabs on, things like the confidence and how oversold or not the market is, and what I'm seeing is, and then the historical context, like the 9 times, and the bear market lasts X this length, whereas the bull market lasts much longer than that with much higher gains, and I'm just seeing that the mood is grim, and that doesn't mean it can't get grimmer, and things won't get grimmer, but it just means that usually when it's this grim, when everyone's this pessimistic, consumers, traders, it's usually a sign that the end is near. It doesn't necessarily mean it is this time. There's always opportunity for it different. But this just makes me think of Warren Buffett's famous phrase: "Be fearful when others are greedy, and greedy when others are fearful." Said that very fast. Be fearful when others are greedy, and greedy when others are fearful. And everyone is fearful right now. No one, you can't, and don't pretend or indulge yourself in a fantasy of trying to catch the bottom. Trying to catch a falling knife. It doesn't happen. I mean, someone will, but it's not going to happen. And 25% down is a good sale if you have money. If you don't have money and you're already invested, we'll get through this. Every bear market, what did Josh Brown say? Every bear market has one thing in common: they end. We will get through this. We will recover. We will go on to new highs. Human beings will turn up at their employers and innovate and grow and enrich themselves and their companies and society. It's human nature. We're not going to stop that.
Mm-hmm.
We're going to keep doing it until we can no longer do it. That's a different podcast. That's Greta Thunberg or Prince Charles maybe. He's quite an environmentalist. But that's a different podcast for a different time. In the meantime, looking at this, we will prevail.
We will. And we will jump from crisis to crisis moving forward.
Oh, yeah. There's not going to be Putin's not going to pull out of Ukraine. It's like, the good times are back. Putin will come out of Ukraine and, heaven forbid, China will invade Taiwan, or something. Something else will happen, or a volcano will go off in somewhere in Africa. I don't know. I can't just keep throwing out potential catastrophes, but something will happen somewhere immediately, and that will become the problem, and then something else, and something else, and before you know it, we'll look back in 5 years, and be like, that was a blip, but look, we've doubled since then, or whatever.
Mm-hmm. The market keeps on churning.
Because it's humans, and humans keep on growing, delivering, innovating.
Mm-hmm.
That's our nature.
It is, and that's what equities
for all
give
our
you.
Many faults.
Yeah.
Yes, that's exactly that. You're buying into that.
You are. Great. Okay. Well, if you've enjoyed this, then we have a long series of podcasts, don't we? You can find a list of these, our technical series, on our website. We are doing a 12-month technical series on topics relevant for Brits in America. So by all means, go check that out. We are 5 episodes in. And there is supporting blogs and videos as well on our YouTube channel. Also, if you are on Facebook, come join us on our Plan First Wealth Hub private community for Brits in America. I'm in there quite often. Rich, I know you're in there too. We have a sort of an open forum, asking questions, feeding back off other Brits in America, and if you've got any additional questions from anything we've said today or anything else, fire them over to us in our Facebook group, and let's keep the conversation going.
Yeah, please join us.
Thanks for listening to this episode of Across the Pond. This podcast is brought to you by Plan First Wealth. For more information about Plan First Wealth and Across the Pond, visit us at planfirstwealth.com. If you like this episode, consider sharing it with fellow Brits across the US. You can subscribe to future episodes in Apple Podcasts, Spotify, or wherever you listen to your podcasts. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.